financial markets. Remember, you can follow us on our Twitter handle, that is at Smart24, or you could visit our website at www.smart24tv.com, and you can follow me personally at Anthony Sebadi on Twitter as well. And we have a conversation on what we talk about here as financial markets. And now we go into our top story this morning. The Nairobi BOAS, or the Nairobi Securities Exchange, has been ranked the third worst performing stock market in Africa. Now, the Nairobi Stock Exchange is the third worst major performing stock in Africa. That is amongst the top 10 East African, stock exchanges. Of course, since January, hit by foreign investor capital flight and ease of repatriation of equity sales compared to other capitals in the continent. The Nairobi Securities Exchange was ranked 8th among the top 10 stock markets in the continent, with a return of a negative 30% in dollar terms since the year started, wiping out 789 billion Kenyan shillings of investor wealth. Ghana and Egypt tied as the worst performing stocks with returns of up to negative 32% in the ranking that put Nigeria Stock Exchange in ranking as the first and the top performer on the 21% returns market analysis done by investment bank EFG Hems shows. Now, the performance of the stock market, that is the stock market of Africa, has recently been weighed down by a reduced appetite for emerging markets after a jump in interest rates in the developed markets such as the United States, which are currently battling high inflation that has forced their central banks to adjust rates upwards. The flight of capital to the United States market, where inflation is at about a 40-year high, which is of 8.6%, and other developed nations, has triggered steep price falls of African blue chip firms listed that are a favorite for foreign investors. Kenya has suffered more pain given that its market is dominated by foreigners who account for 55% of the total turnover, and the lack of restriction on moving foreign exchange in and out of the country. On the other hand, it has been difficult to move capital from Nigeria, forcing investors to either put or rebalance their portfolios within the market of Nigeria. Despite a reported dollar scarcity locally and in several other African countries, the Kenyan market seems to be the least restrictive in terms of dollar access, and hence makes it easier for foreigners to sell off their dollars. Additionally, the Nairobi Securities Exchange is fairly liquid compared to other regional exchanges, according to Mr. Solomon Karikui, who is the head of research at AIBS Africa. Now, the value of the Nairobi Stock Exchange has fallen to lows as last seen in 2017, since the BOAS, of course, started rising in terms of points. The value of all the stocks stood at 1.847 trillion compared to 2.636 trillion at the start of the year. While the Nairobi Stock Exchange main index has dropped 10-year low on foreign investors' flight. The Nairobi Stock Exchange 20-share index closed at 1,580 points, a level that was last seen in, of course, 2003, that is, since the index was begun. The Nairobi Stock Exchange, of course, being ranked third worst exchange in Africa comes as a result of quite a number of factors that have hindered the trading on the market, with very many investors opting out of the market and leading to capital flight, since most of the investors have been, of course, from other countries. The value of all stocks stood at 1.84 trillion and compared to 2.636 trillion at the start of the year, while the Nairobi Stock Exchange main index dropped to a 19 low Boaz comes on the back of Safaricom share price, which accounts for more than half of the stock market valuation and has shed 38% since January to 24 Kenyan shillings from 37.95 shillings per share. Foreigners have an outsized exposure to the stock owing to its large liquidity and business performance, including profits and dividends. Safaricom is the most exposed name to the sell-off globally, as it had attracted crossover margin markets money, said Mr. Muwathi Kilonzo, who is the director and head of equities at EFG. Secondly, the shortage of foreign currency to repatriate proceeds to international investors, at times going on weeks, has also created a vicious cycle where concerns of being trapped drive selling. Unfortunately, investors have an ongoing bad experience of being trapped in Nigeria. Local institutional investors have at the same time failed to step in and provide demand for the stocks as foreigners sell off now and are instead pushing their capital to fixed income investments such as government bonds, which are currently offering better returns and safety compared to equities. Mr. Kilonzo says that investors are concerned with Kenya's macroeconomic conditions, including high inflation, a depreciation of the shilling, which has dented the purchasing power of Kenyans and hurt consumer stocks such as the East African Breweries Limited. The shilling's performance against the dollar is a big factor here at the stock exchange, a stock market for foreign investors who suffer exchange losses or make gains depending on whether it is depreciating or appreciating against the greenback. When entering the market, foreign investors convert their dollars to the shillings and to do the reverse after selling to shift capital out of the country. Should the currency depreciate between the purchase and sell periods, they suffer losses since they stand to get fewer dollars when exchanging for exit purposes. Should it gain, they enjoy more dollars on exit. Now, this year, the shilling has depreciated by 3.9%. That is the Kenyan shilling against the dollar, exchanging at a mean of 117.5 just of yesterday, which, when coupled with the capital losses on major stocks, has foreign investors looking at a major portfolio erosion. That is, of course, the story coming in from from the Nairobi Stock Exchange, being the third least performing exchange, of course, according to data that comes in from EFG. Now, remember, the top 10 have been ranked, and given the basic, we can look at other markets that have been ranked here, with Nigeria leading at we have Botswana in the negative as well. We have Mauritius. We have the Boal Regional, the VAL, which is the West African stock market. We have Tanzania. We have Johannesburg coming in the 5th place, then Morocco, then Kenya and Ghana and Egypt, which tied in the last position with a 32% depreciation in stock value. So, what does this mean for us here? Of course, Kenya has been facing very many problems, just like us here, but they have been aggravated by quite a number of factors that have come at a very difficult time. First of all, the entire world is grappling with inflation, but in particular, Kenya is struggling with inflation as well, increasing the central bank rates to over about 7.5 now. Even last year, we increased from 6.5 to 7.5. But in Kenya, that brought adverse effects on the interest rates or the coupon rates of treasury bonds and bills. And so very many local investors opted out of the equity market to invest in the security market. And of course, this is safer and more, at least more, right now, more profitable, with more returns in the long run compared to the equity market. And given the fact that now many investors are foreign, given the fact that they give more access, Kenyan market is very much accessible to foreign investors. These have fled the market, leaving various holes and selling at very low prices. As you know, the stock market works with demand and supply. So they are selling quite quickly, and they are not buying. There are not very many buyers as well. So that creates, a depreciation in price, in value of the stocks that are being listed. So as they pull out, they go with the dollars, and of course, this creates it exacerbates the already existing problem of the shortage of the dollar, which is right now currently trading at about 118. To purchase a single dollar, and of course they buy goods expensively then. So surrounding all this is also the looming elections in Kenya, given the fact that elections are around the corner. I think by November or something they'll have elections, and this still creates uncertainty and contributes to probably the capital flight we are seeing in Kenya. But of course, it's all not dull and gloomy for the country. Since it's the biggest exchange in East Africa and still is the biggest exchange, I'm sure they will get back up. They'll pick up the pieces and get back up. It's not the worst they have seen, but the worst since 2017 that they have seen on the market. We'll follow up with more of that story later on, but of course, moving on to the next story here in Uganda. Of course, a study from Bank of Uganda has shown that 6 out of 10 Ugandans save for consumption. Now, despite the 7 out of 10 Ugandans actually knowing the importance of saving, only about 6 of the 10 Ugandans adults save, and mainly they save for food and consumption, according to Bank of Uganda. Speaking at the launch of the National Social Security Fund, Smart Card, Bank of Uganda Deputy Governor Dr. Michael Atingi Ego said that according to Financial Capability Survey, which was compiled by the central bank, it was found that whereas most Ugandans understand what saving means, most of them, almost half of the working adults in Uganda, in the Ugandan population, that's about 22 million, have no formal saving mechanism. Therefore, he said the survey found out that 44% of working Ugandans prefer to save with village saving groups, and such as loan associations, with 42% save in saving boxes. This Mr. Atingi Ego said that is not only a safer way is not just a safe way of investment, but sucks money out of circulation in the economy. The survey noted that also 57% of adults between 25 and 54 years had saved in the last 12 months, leading to the survey. However, majority of these which represents 54% had saved for consumption on specifically food. And the findings, he said, reflect how Ugandans live, which is in the financial sector stakeholders. Bank of Uganda has an obligation to understand them in order to make a difference in their decision making. A number of social transformation initiatives, Mr. Atinji Ego said, have been formulated which seek to transform at least 54% of Ugandans who save to consume, to save actually to invest. According to the Financial Capability Survey, at least 25.4% of Ugandans save for investment, and while 21.7% of Ugandans save for school fees. Similarly, 21.7% save for emergencies, and 20.4% save to invest into housing and home ownership. Dr. Atinji also said that there was need to, of course, for more innovation and to boost the financial capabilities of Ugandans, noting that innovations such as Social Security Smart Card have become at the right time because many of the social initiatives are seeking to leverage on technology to improve efficiency and consumer experience. Therefore, he said Bank of Uganda is working on a number of areas that seek to make saving a way of life for Ugandans. The Financial Capability Survey also indicates that 25.9% to save to invest in agriculture, and 12.5% save for investor assets, while 7.4% save for medical care. Now, only 0.7% undertake savings planned for leisure activities. Mr. Richard Byarugaba, who is the NSSF Managing Director, said that the Social Security Fund Smart Card will enable NSSF members to remit contributions and use it to receive their benefits are due. He also noted that Ugandans should move on from saving money in boxes because, apart from being an unsafe way of saving, the money does not earn interest, yet its value keeps reducing as a result of inflation. That's according to Mr. Byarugaba Richard, who is the NSSF director. And of course, this exactly reports what we are preaching here in as financial markets, that the money you keep in a box, that money you keep in that savings group, and lock that box and give it to someone to keep it under probably their bed, that money is creating inflation, literally increasing prices of goods and commodities. Why? Because the money is non-productive. It's not earning interest. And the more you keep it, it's as if it is actually, it sucks money out of circulation, because money has to be used always to produce something. So every time we keep money and that money is idle, our money lose value. How? Because 10 years ago, with 10,000 shillings, you could probably purchase a whole basket of groceries from a supermarket. But right now, you probably can only purchase probably one loaf of bread and a small tin of margarine. Why is that? The currency is losing value. The currency can no longer purchase as much as it used to with the same unit. So meaning 1 Ugandan shillings or 1 cent has lost value. Why? Probably the money has somewhere in circulation, has been sucked out and is not being productive. This is just one of course, of the many factors that could surround loss of value or in a currency. And so this is why saving in boxes is very dangerous. It's actually more dangerous than spending. Because look, when you spend money on something, at least you're helping that other business to grow, you're helping that other person to probably invest more. You're not helping the economy, you're doing than good. And that's why this report actually brings out the fact that it's dangerous to save without investing. And financial markets are giving you the opportunity. Of course, many people save and start with, starting a business. Maybe they want to open a grocery shop. Maybe they want to open an MTN a mobile money outlet. But with these investments, you don't have to open anything. You don't have to open a shop. You don't have to go to work every day. You don't have to monitor how businesses are running. Simply put aside money, invest it using your mobile phone. With Altex, at least Altex has made it easy. With dialing *292#, you can invest. And then, of course, other savings groups like the NSSF fund can help you use that money that you're going to save for retirement. Maybe, for retirement in the long run. Of course, this is a mandatory scheme, but they save that money and invest it. This is what NSSF does. And history has it that NSSF actually redeemed some companies on the stock market by investing in them. And these companies grew to where they are now because NSSF invested in them. Mind you, NSSF can probably have for example, in the Umeme returns, Umeme, after its financial results this year, declared a dividend of about 54.9 cents per share. And of course, this resulted in a loss of about 73.6 billion in terms of the value that they had. But NSSF took most of that dividend. Yeah? Most of that dividend that was declared was given to NSSF because it had the highest stake in the company, with over 25% of stake in Umeme. So this is exactly what this report brings out. The fact that Ugandans are saving to eat, Ugandans are saving to make ends meet, but you should save in the long term for investing and for future returns. Save for your children's education. For example, in the life insurance fund, maybe in the emergency fund. And of course, all these fund managers around are here to help you just do that. And of course, we'll be happy at the end of the day. Just to take you briefly through the process, if you want to get started, especially on the equity market, you simply need your mobile phone or your smartphone. Access, of course, MTN mobile money, *292#, and Altex will give you all the securities that are listed in East Africa, including the equities, but as well as the treasury bonds and treasury bills. We hope that, of course, was of help. But another report, of course, showed that 58.9% Ugandans don't care how much they spend. And of course, more than half of the adults, working adults, which represents 58.9%, do not care how they spend money, according to the same report. Of course, this is a 27-page document called the Financial Capability Survey that was conducted by Bank of Uganda back then in 2020. It highlights that a number of issues, among which include household incomes, insurance uptake, saving and financial management, among others, are key to financial growth of the country. So its findings were based on that was conducted on over 3,000 households. Now, the survey interrogated working Ugandans on a number of parameters, and 58.9% of which said they do not care how they spend their money. Close to half of the respondents, which represents about 46.2%, the report further indicates, say that they live for today and let tomorrow take care of itself. In notes published together with the report, Deputy Governor said the Financial Capability Survey sought to examine financial knowledge of working Ugandans, their attitudes and financial behavior, which are integral in facilitating effective decision making. This survey was timely and, of course, gave us information as to regards what the saving culture is in Uganda. Now, according to Uganda Bureau of Statistics as well, only about 12% of savings to GDP ratio is what Ugandan markets look like. But when you go to Tanzania, they're at about 13%. Rwanda, they're at about 18% savings to which is quite something we need to improve and probably adjust if at all we are to move into probably bigger economic statuses, like, of course, the president declared the middle income statuses and so on. But the key here is, if you're to pick away something from what we just shared in this report, saving is not enough. Save and invest something. And financial markets are a good way to save and invest because they don't need your input. They don't need your daily input. All they need is your idle savings, your residual incomes, and they shall do the work for you in the long run. Of course, we look at cryptocurrency and the URA taxes here, and then, of course, look at the international global stock markets as they have played out. Don't go anywhere. We'll be right back.